4%. That's the new Bank of England base rate, the lowest we've seen in more than 2 years. On paper, it's a modest quarter-point drop from 4.25%. But behind that number lies a story of economic slowdown, political pressure, and a central bank walking in a tightrope between taming inflation and avoiding recession. For borrowers, the headline suggests relief. For savers, it's another squeeze. And for the wider economy, it's both a gamble and a signal. Today we'll unpack it all. The decision, the rationale, the reactions, and what it really means for your mortgage, your money, and your region. The decision and the context. Let's start with the facts. The Monetary Policy Committee, 9 members on 1 vote each, met and voted to cut the base rate from 4.25% to 4%. That's a level not seen since March 2023. It's the third cut this year, the 5th since last August, and why the move was widely expected by financial markets. The reasons behind it mark a subtle but important shift in strategy. For most of the past 2 years, the bank's battle plan was clear: hold rates high to choke off inflation. And inflation, measured by the Consumer Prices Index, has indeed fallen from double digits to 3.6%. Still above the 2% target, but far closer than it was. Yet in August, inflation wasn't the main driver of this cut. Instead, it was the labor market. Wage growth has slowed, unemployment has ticked up, and indicators from GDP to retail sales point to a cooling economy. The bank believes there's now less upward pressure on prices and more risks for economic weakness. A tactical shift. In military terms, the bank has been holding the line, keeping rates elevated to defend against the inflationary enemy. But every commander knows you can't win one front if another collapses. The labor market front is showing cracks. GDP is under strain. The bank has decided to redeploy, lowering the cost of borrowing to stimulate demand. But this move isn't without critics. Former MPC member Andrew Sentence warns inflation could rebound above 4% this autumn. In his view, the paces of cuts, 5 in less than a year, risks undermining the bank's credibility. His fear that inflation could rise again before it's been fully defeated, forcing a painful reversal. How a rate cut works. The simple mechanics. So how does a quarter-point cut makes its way from the marble halls to the thread-needle streets to your monthly budget? Think of it in 3 steps. Step 1. The bank rate falls. This is the interest rate the Bank of England charges commercial banks for borrowing money. When it drops, banks' own funding costs can decline. Step 2. Lenders reprice. Mortgage providers, credit card companies, and banks can pass some of those savings to customers. Variable and tracker mortgage are quickest to adjust, sometimes within weeks. Fixed rate deals are different. They follow the movements of a longer-term financial markets, which often anticipate rate changes before they happen. Step 3. Households feel it. If you are on a variable or tracker mortgage, your monthly payment could fall, but only if your lender passes on the cut. If you're on a fixed rate, your payment won't change until your term ends. But when it does, you might find new deals cheaper than before. Why? You might not notice it immediately. Here's the catch. Lenders saw this cut coming weeks ago. They've already priced it into many products. That means the mortgage deals on the high street today may not shift much in the short term. Sometimes it takes the next MPC meeting or a series of cuts before banks substantially realign their offers. In other words, don't expect your monthly bill to tumble tomorrow morning, especially if you fixed your rate during the peak last year. The effects of a single cut are often gradual and uneven. Winners and losers. Who stands to benefit? First, borrowers on tracker or variable rate mortgages, especially in regions where these products are more common. Businesses relying on short-term loans could also gain, with reduced cost improving cash flow. The losers? Savers. A lower base rate means banks can reduce what they pay on deposits. For retirees and others living off interest income, it's an unwelcome squeeze. And then there's the middle ground. People who might gain on one side of their finances but lose on the other. Someone with a mortgage and substantial savings, for example, could see the benefits cancel out. The regional map. Now, let's put this on the map. In London and the southeast, where property prices are high, even a small percentage drop in mortgage rates can translate into hundreds of pounds a year in savings. That could make housing slightly more affordable, or at least less punishing for those renewing deals. In the north of England, Scotland and Wales, the absolute pound value savings may be smaller, but the relative impact on household budgets can still be significant. In areas where wages are lower and housing markets less overheated, an extra 25 or 30 pounds a month can free up meaningful spending power. Take Manchester. A household there with a £200,000 mortgage on a variable rate could save roughly 25 to 30 pounds a month if the lender passes through the full cut. That's grocery for a week and a tank of petrol or a small boost to savings. When cheaper borrowing fuels higher prices. But there's a flip side. Cheaper borrowing can stoke demand for property. In areas with limited housing supply, that can push prices up, potentially erasing the affordability gains from lower interest rates. From first-time buyers, this can be a frustrating cycle. The mortgage is cheaper, but the house you want is suddenly more expensive. Political reactions and budgetary pressure. This rate cut also has political ripples. The government, facing a projected 40 to 50 billion budget shortfall according to the National Institute of Economic and Social Research, is under pressure. The Chancellor will likely frame the cut as a vote of confidence in economic management. Critics, however, argue it's more a sign of weakness that the bank is acting because growth is faltering and joblessness is rising. Public spending has surged in the past year. GDP growth is tepid, and while inflation has eased, it's still nearly double the target. The bank's primary mission remains to bring inflation to 2%. Cutting while it's at 3.6% is a calculated risk, one that depends on inflation continuing to fall. A look back, lessons from history. This isn't the first time the bank has cut rates in the face of economic slowdown. In 2008, as the global financial crisis unfolded, rates fell from 5% to just 0.5% in under a year. In 2020, at the onset of the pandemic, they dropped from 0.75% to 0.1% in a matter of weeks. Those cuts were far larger than faster. Emergency moves in extraordinary times. Today's situation is different. Inflation is still above target, and the labor market, while weakening, isn't collapsing. This is a more measured easing, a nudge rather than a plunge. The danger is that it could prove too small to lift growth or too large to keep inflation in check. Market reactions. Financial markets reacted modestly. The pound rose slightly against the euro and the dollar. Two-year gilt yields, a proxy for interest rate expectations, edged higher, suggesting investors believe the bank may not cut aggressively from here. In the mortgage market, the response will be slower and more uneven. Fixed-rate deals, which depend on swap rates and bond yields, may already reflect expectations of further cuts. Variable rates could adjust within a month or two, depending on the lender. The path ahead. What happens next depends on the numbers. If inflation drifts down towards 2% and unemployment rises, the case for more cuts strengthens. If inflation ticks back up, as some like Andrew Santens predict, the bank could pause or even raise rates again. The MPC is walking a narrow path. Stimulate too much and risk reigniting inflation. Stimulate too little and risk a deeper slowdown. Practical steps for households. So, what should you do? If you have a mortgage, check your type. Tracker or variable. Expect to see changes sooner. Fixed. Monitor the market as your renewal date approaches. Run the numbers. Even a small rate drop can boost your borrowing capacity. But remember, lenders stress test your income against higher rates to ensure you can handle shocks. If you're a saver, look for the best fixed-term products before banks adjust rates downwards. And if you own a business, consider refinancing debt now to lock in lower costs. A cut to 4%, the lowest since March 2023. It's a modest change but one loaded with meaning. For borrowers, it may offer some relief. For Bank of England, it's a strategic shift. For the economy, it's a gamble that growth needs more help than inflation needs restraint. Whether it works will depend on the months ahead, on inflation's path, on the job market's health, and on how households and businesses respond. The lever has been pulled. The effects will ripple out, and all eyes will be on the data to see if the move was a step towards stability or the first misstep into a new round of challenges.